In 2025, markets gave us thousands of reasons to react. I took lessons from the past and reacted less than ever before, and my portfolio was better for it. Let's review what actually moved the needle and what made no difference. If you felt busy as an investor in 2025, you weren't alone. But busy didn't necessarily equal getting paid. This is what we call the illusion of signal. Markets in 2025 were information dense, not insight dense. And we see this from the thousands of signals that we got. Whether it was rate expectations, AI narratives, geopolitical headlines, or earning cycles, there was a lot going on this year. So while market commentary went up, that doesn't necessarily mean decision quality went the same direction. And because headlines amplified urgency for investors, that made every move look like it required action. And we see this in the data. A lot of retail investors increase their trades during very volatile or drawdown periods. These high churn periods often coincide with periods of drawdowns rather than when markets are in recovery. I have seen this in my own portfolio where copiers exit disproportionately after a volatile period and don't often return until prices are high again. What actually mattered? There are really three pillars that are the cornerstone of what makes a good portfolio. The first pillar is consistency. Consistency beats cleverness any day in the markets. And that's because we saw returns coming from remaining exposed rather from timing brilliance. As usual with this sort of phenomena, we saw a handful of days really drive the returns for the markets this year. And missing those couple of days were really more important than avoiding the drawdowns on the bad days. So while a small number of trading days drove most of the returns this year, it meant missing them was more impactful to investors than trying to avoid drawdowns. The second thing I saw in the portfolio this year was that process matters more than opinion. I had a couple of opinions this year that didn't play out in the short term, but it didn't really matter because I didn't let them override portfolio positioning, position sizes, exposure limits, or holding periods. So that meant that my system could absorb the uncertainty without requiring any action. And thankfully so, because as I said, those opinions were wrong in the short term. So, in the portfolio this year, that rules based consistency meant that we were not on variance, and it was more important for ultimate returns than forecasting accuracy. This is what happens when behavioral errors start to cluster around discretionary overrides. And that means that moments when I really wanted to intervene were the ones when I really shouldn't. And that's where the system, the rules, really protected the portfolio. The third pillar, if you know me for all these years, you'll know that's discipline because discipline beats activity any day. The fewer decisions we can make, the fewer opportunities we have to introduce error. So by trading less, there's less friction and less emotional fatigue in the portfolio. So while not reallocating can feel passive, it's really very intentional in a long-term portfolio. Together, consistency, process, and discipline are the three corner pillars that holds the portfolio steady no matter what happens in the market. That allows me not to respond to certain things, like, for example, taking action based on daily macro news, any short-term forecasts, panic exits, or any pressure that demand real-time moves. Ignoring these things wasn't negligence, it's part of the system. One bad reaction exceeds several good ones. And one good example that stands out, it's the drawdown we saw in April. A lot of people chose to pull out during this time. A lot of market sentiment was negative. I chose to stay invested. In fact, whatever cash I had on hand, I used to get in at that point in time, and I was handsomely rewarded for it in the months that followed. That's because the process said to do nothing. The analysis had shown that it wasn't a large structural collapse, although all the headlines were shouting that this was the AI bubble collapsing. Holding at that point in time really preserved optionality. Although the win was very sweet in terms of the returns, that wasn't the ultimate win. It was also avoiding the mistake of pulling out of the market because that would have meant missing the upswing that happened shortly after. This is a good reminder for investors that markets reward emotional regulation more than intelligence. Most underperformance is not caused by flawed analytical thinking, although sometimes it is, but very often it is almost purely behavioral because the investor lets their emotion take the lead. 2025 was really the year where long term investors who reduced decision making and intervention outperformed those who kept tinkering and were essentially a bit unsure about their thinking. So, the lesson for me in 2025 is that compounding really punished the impatient investor this year. I often get asked, how do I remain so calm during market downturns? Calm is not a personality trait. If anything, I'm very impatient. It's a learned skill that comes with practice. And for me, it comes with more than 10 years of publicly managing this Toro board. One of the big takeaways I get from my copiers this year is that copying isn't just about copying the trades or the positions of an investor. Copying is about copying the restraint, the rules, and the time horizon of the thinking behind the portfolio. If this resonates with you, it probably says more about your temperament than my returns in 2025, although they were pretty spectacular. In summary, the edge in 2025 wasn't knowing more in an era of AI. It was about needing to do less and having a system to support the investment process.